Welcome everyone to the Microstructure Exchange, and today's session that will be with James Brugler with a paper on dark pools. Before we begin, I have a small announcement. Albert and Carole, who are here, are organizing a conference in Amsterdam, and they have just published the website where you can check out the agenda and register. It's a conference for transparency and market structure, so it should be very relevant to this crowd. We will put the link on the website. It's not there yet, but I'll put it in the chat here, and you can check it out and go there. For the seminar today, James has told me that he's happy to take your questions whenever they come up. So feel free to raise hand whenever you want, or type into the chat box, and then I'll forward the question to James. And if there are no questions on the fly, I think James will stop a couple of times for questions during the talk as well. And he will stay here for as long as we have questions, with the constraint that it's already 1 a.m. in Australia, in Melbourne. So let's keep that in mind. James, the screen is yours.
Thank you very much, Bjorn. I'll just share my slides. So perhaps just let me know that you can see them okay.
That looks great. Go ahead.
Okay, great. Well, hello everyone, and thank you a lot for having our paper on the program. Like Bjorn said, my name is James Brugler. I'm an assistant professor of finance at the University of Melbourne. This is joint work with my colleague Carole Comerton-Forde, who is professor of finance at the University of Melbourne, and she has kindly agreed to join the call as well. So you can certainly get both of our insights on the paper as we progress through it, and perhaps at the end of questions as well. So this is a paper, like Bjorn said, about dark pools. And in this paper, we're specifically going to be considering an aspect of heterogeneity in dark pools, or a dimension of heterogeneity in dark pools that hasn't been empirically explored before. And that is the degree to which different kinds of dark pools implement access restrictions on the types of traders that are permitted to enter orders into their platforms. Really pleased to be presenting in this program. Certainly one of the positive things that have come out of living through the last few years, from my perspective, is the advent of these kind of seminar series, which allow people like myself who are geographically a long way away from kind of the center of research in these areas to reach a wider audience. And it's great to have these operating in parallel to the the crucial in-person series that we have as well, like the main conferences and so forth. So really looking forward to getting your comments. Now, Bjorn mentioned that when we tested the slides that there was a little bit of lag potentially in the animation, so I apologize for that in advance. I suspect that's to do with latency issues, which is very relevant for the talk. Now, in this forum, there's not a huge amount of need for me to go over the fundamentals of dark pool trading. Most people here will be broadly aware that dark pools are trading platforms that allow execution of orders or entering of orders without pre-trade transparency as to the order direction or size. And these platforms are important, particularly for institutions, not only because they limit pre-trade transparency, but they also often, but not invariably, allow for price improvement over trading on the limit order book at the best bid or the best ask. So they play an important role in allowing institutions to reduce their trading costs by trading at the midpoint. And potentially something that's very relevant for our talk is that they allow institutions to reduce information leakage by not displaying their orders or trade direction to the entire market. What's more important for our talk, and what might be a little bit less familiar to this audience that I'm speaking to today, are the features of the Australian equity market, and particularly the structure of dark pools in our market, where there are a number of kind of relatively unique features that kind of motivate our research today. So in Australia, in the equities market, we have two categories or two broad categories of dark pools. And these are, the first categories are the exchange operated dark pools. And these are dark pools that are operated by the two major exchanges that facilitate trading in Australia. The first is Centrepoint, which is operated by the primary exchange, the ASX. And Centrepoint is a dark pool that's operated by the ASX. The matching engine of Centrepoint is integrated with the limit order book, the display limit order book of the ASX, but it operates as its own dark pool that allows customers to input their orders. In parallel to this is a hidden liquidity feature on the exchange operated by Cboe Australia. This previously was Chi-X, but very recently was bought by Cboe. And that operates in a broadly similar manner to the way that Centrepoint does on the ASX. So that's the first category of dark pools. And that in itself, the fact that we have these exchange operated dark pools, particularly Centrepoint, which has quite a large market share, is kind of a unique feature compared to many markets in the EU and the US. Now, the second category of dark pools are the more standard dark pools that you might be familiar with, which are broker operated. And a crucial feature of the broker operated dark pools is that they're permitted to restrict certain types of traders from accessing their systems. And typically the kinds of traders that are restricted from accessing certain broker dark pools are high frequency traders or electronic liquidity providers, as well as proprietary flow from the brokers, the broker's principal trading or trading for their own account. So in the first category, in the exchange operated dark pools, there are by mandate no restrictions on the kinds of investors or traders who are allowed to input orders. If you have access to the ASX trading platform, the limit order book, then you will be able to input orders into Centrepoint. And likewise, if you have access to Cboe, then you'll have access to the hidden liquidity features within Cboe. The brokers, on broker dark pools, the brokers are permitted to bar certain categories of traders. So the concept of kind of fair access provisions are quite different in this market relative to others. And this motivates kind of our research questions here. Sorry to be moving through the slides like that. So our research questions that follow here are firstly, whether or not there are observable differences in execution outcomes between trades that take place in exchange pools, those that have unrestricted access, and broker dark pool trades where certain trader categories are restricted, can and are restricted from inputting orders. And then conditional on what we find for the first question, our second question is whether or not we can make any claims about causality here. So when we answer the first question, in the first setting, we're going to be thinking about this kind of in a standard panel regression setting, but there are various endogeneities that we may not be able to deal with in a standard panel. So we're going to have an identification strategy that goes beyond simple regression to give us a little bit more confidence that the inference that we're drawing is appropriately causal, not just correlation. And then the last question that we're going to try and answer in this paper is, if there are observable differences in execution outcomes, can we plausibly attribute these to the fact that there is variation in access by trader categories across these types of dark pools? Now, one thing that I want to mention up front is this term execution outcomes. And we thought quite carefully about this term, and when we say execution outcomes, we're effectively talking about execution quality that's conditional on a trade taking place. So in this paper, we do have some really nice data that are available to us as Australian researchers that facilitate this research. But one thing that we don't have is information about parent orders or unexecuted orders that were not filled. So everything that we're talking about in this paper when we're talking about execution outcomes and execution quality is conditional on a trade taking place. So we're really just capturing, when we think about, say, an institution and their ability to conduct the kind of trades that they need to do, we're thinking really about one dimension of overall execution quality, which is once you do get a fill, what happens to prices and spreads in the subsequent periods after that. We can't say anything about execution fill rates or how they feed into things like implementation shortfall. So a caveat that we want to be very open about up front is that we're focusing here on everything is conditional on execution because we don't have the order information.
James,
okay, so Yes.
There's a clarification question in the chat from Evangelos. Are there any minimum trade size restrictions for using the exchange dark pools? Now I see Carole just responded.
Okay, so I mean, I think that Carole has answered that appropriately. Yeah, so I'll let her.
So no explicit restrictions.
No,
then there's another question. For those unfamiliar with dark pools, is the essential feature that they can place limit order that are not observable? Is there anything else that is important?
Well, I mean, certainly the lack of pre-trade transparency, as you refer to there, is kind of a key feature. I think probably one of the other really important features of dark pools is that price discovery doesn't directly take place in dark pools. So the prices, the trades at which executions are taking place in the overwhelming majority of dark pools is going to be determined by what is the best bid and the ask on the displayed limit order book. So for example, in our setting, every trade that takes place on a dark pool has to come with price improvement relative to the MBBO. So the prices at which executions can take place are only those that are inside the current MBBO. So I think aside from pre-trade transparency, probably the one thing that comes to my mind is the lack of direct contribution to the price discovery process through the pegging of order prices.
Thanks.
Okay, so yeah, please just definitely stop me anytime there are questions coming up in the chat. I won't necessarily see them myself, so thank you for that. Okay, so I'll give you a quick preview of our findings. And then after that, I'll try to place our paper in the current literature and outline what our contribution is, at least at this stage, what we argue to be our contribution. So the headline result in this paper is that we find broker dark pool trades do have better average execution outcomes than those that take place on exchange dark pools. So once we take into account our condition on trade characteristics, control variables at the stock day level, and stock and time fixed effects, we find conditional on all of this that broker dark pool trades have less information leakage and result in less subsequent adverse selection risk for liquidity providers than do otherwise comparable exchange dark pool trades. What do I mean by information leakage and adverse selection? I'll come to that in a few slides' time. But for now, this is just to outline the headline results. We find some kind of mixed evidence on the probabilities that the prices will reverse subsequent to a trade in a broker dark pool versus an exchange dark pool, and also on the speed at which prices adjust to kind of the new long-term equilibrium. So this is our first finding is in this regression setting. So it's conditional on fixed effects, it's conditional on controls, but like I said, there can be endogeneity that we may not be controlling for in such a setting. So we have an identification strategy that revolves around looking at brokers whose dark pools close during our sample period as a source of potentially exogenous variation in trade location. So whether a trade takes place on an exchange dark pool or a broker dark pool, we're going to use these brokers who close their pools. We're going to look at the kinds of trades that these brokers execute and compare these with that they then subsequently execute on the exchange dark pool and compare these with broker dark pools. And when we do this, we confirm our initial result. So our identification strategy essentially confirms that broker dark pools have less information leakage and less adverse selection risk than do trades that take place on exchange dark pools. Then our third question was, can we plausibly attribute this to access restrictions? And here we find evidence that really supports this hypothesis. And this comes from two sets of analyses. The first is when we just start looking within categories of broker dark pools, we find that the kinds of broker dark pools with the highest grades of restrictions on HFT and ELP flow have less information leakage and adverse selection risk than pools that allow traders, allow some of this flow or allows this flow to enter the pool, but give other traders the opportunity to potentially opt out. So our broker dark pools also have heterogeneity within their access restrictions. And when we look within this category of dark pool trades, we find consistent results with when we look across the broader categories of broker dark pools versus exchange dark pool trades. We also find that the differences in our sample or at least the differences that we observed, are concentrated in small trades. So when we stratify our sample into smaller trades and larger trades, and we argue that smaller trades are those where we're much more likely to see high frequency trading and electronic liquidity provision on one side, we find bigger differences in information leakage across the broad category of broker dark pool versus exchange dark pool trading. So how does this kind of fit into the broader literature on broker dark pools and high frequency trading? The idea or the importance of heterogeneity in market structure within dark pools hasn't had very much attention in the empirical literature. So the key counterexample to this is Menkveld, Yuchen, and Zhu, JFE 2017, who document the existence of a pecking order within dark pools based on the matching mechanisms that are used within dark pools, so that they stratify the trading platforms available from midpoint matching dark pools, which are the lowest cost with the lowest likelihood of immediacy, to non-midpoint matching dark pools, and also trading on the display limit order book. So they have this hierarchy from lowest cost, lowest immediacy to highest cost, highest immediacy, and they show that traders route their orders in a way that is consistent with that pecking order, and they use a vector order regression with a number of identification techniques to validate this analysis. So this is really, to our knowledge, really the only empirical paper that focuses on the fact that dark pools can have very different kinds of trading rules, and that can affect the way that orders are submitted and outcomes that take place. Our paper's also going to feed into a growing literature on how high frequency trading affects execution quality or execution outcomes. So, for example, the theory of Yang and Zhu about backrunning, this is quite important for us. So in backrunning, a high frequency trader observes public information about the history of order flow. And from this public information, due to their ability to process signals well, allows them to infer some of the private information that's embedded in those signals. And that's very much kind of a mechanism that we're exploring in this paper. Other results that are complementary to this, that are empirical, like Hershey 2021, that HFTs can anticipate and trade ahead of order flow. Karajcek and Murphy, as well as Van Kervel and Menkveld, show institutional trading costs rise when HFTs are trading in the same direction. And Battaglia, Hatch, and Saglam show implementation shortfalls rise when orders are exposed to ELPs. So in our paper, we're contributing to these kind of two strands of literature. Firstly, we're analyzing a new dimension of heterogeneity in dark pools, that is access restrictions. So the degree to which dark pools in different categories can prevent certain kinds of traders from entering orders, and we're studying how this affects outcomes. And we show causally that this does have an effect on outcomes conditional on execution, so post-trade outcomes. We further show that this is due to segmentation of institutional orders away from HFT and ELP counterparties. And so in some sense, what our paper is doing is linking these two things. So we have this knowledge of the way in which HFTs interact with institutions that can have potentially detrimental effects on their outcomes. We also have a literature on the role of dark pools, and our paper really sits at the intersection of these two things. We also have some kind of what we think to be quite important or potentially important consequences from a regulatory point of view. If you think about the landscape in the EU and the US, in the US, alternative trading systems are allowed to segment order flow so long as their market share it stays below 5%. As soon as it goes above that, fair access requirements kick in. In the EU, broker crossing networks that were previously permitted to implement access restrictions were banned, and there was not a appropriate cost-benefit analysis that took place around that decision. And our results, if they carry over into the EU setting, have potentially important implications for that. Okay, so I might just stop there because that's really kind of the broad overview of the picture to see if there are any particular questions, but also very happy to take them as they arise, either in whatever forum works.
So I think Albert is raising the hand.
Yeah, the physical hand, because I couldn't find the button quick enough. This is very exciting. I just want to see how do you think about this setting that you have here? Is it, what type of equilibrium do you have in mind? Is it first the heterogeneity in pools and then HFTs select into particular pools that will be hard to get access? Or is it the other way around, that first HFTs are scattered around pools and then particular institutions are attracted to particular pools? What type of equilibrium do you have in mind here when interpreting the results?
So it's a good question. And I think the key decision maker in the economics that kind of underlie what we're looking at here is very much the brokers. So when we think about kind of the market structure here, and also not just the market structure, but also the way in which clients' order flow actually does get executed across the different venues that are available. These are largely broker decisions. So the way that we look at this is that there's sort of an ecosystem of brokers offering slightly differentiated products. Banning HFTs or ELP is not, and our results are quite clear about this, it's not a dominant strategy, because once you do this, there's a clear trade-off, and that trade-off is fill rates are lower. So in some sense, you could think about the decision to restrict HFT and ELP as kind of a pecking order, where, and similar in some sense to the setting that your paper with Bart and Hashing has, in that once you ban HFT and ELP, you're going to reduce the likelihood of immediacy, but also reduce the costs conditional on execution. So I would say that the equilibrium we have in mind is one where different niches are being filled by the brokers, and it's not clear which is the best or not the best. Then institutions make their choices about where to trade, potentially based on the outcomes that happen in the broker dark pools. Though from the conversations that we had with brokers, and we had many of them, it wasn't clear that the presence of a broker dark pool, even if you had one or not, was a key factor in the decision of the institution to route to the broker. There were other factors that were much more important there. So I don't know if that answers your question, but that's sort of the way that we're thinking about it.
Yeah, thanks.
Okay. So there are two more questions in the chat about the heterogeneity of between the dark pools. So Vincent is asking if all of them have the same price setting mechanism at the ASX midpoint, or if that differs. And Evangelos is asking about access fees in the dark pools. Is there any variation in the cross-section there?
So I see Carole has said to Vincent that the key thing about price setting mechanisms in the Australian dark pools, they must offer price improvements. So and this is typically at the midpoint. And if the spread was, if we're not tick constrained, it could be at ticks within the midpoint, but that they must offer price improvement to facilitate trading. Evangelos's question on access fees between the two types of dark pools. So yes, and Carole, again, feel free, please, to correct me if I'm mistaken here, but my understanding is that broker dark pools have lower fees. So the cost of the explicit fees charged with trading on, say, center point are significantly higher, or at least meaningfully higher than they are on broker dark pools. And certainly a broker doesn't pay any fee to trade in their own pool. So the explicit fees are a relevant part of the decision as well. But I think this is quite important for kind of, again, to go back to the underlying who are the decision makers here and what are their kind of incentives. The decision about how to split the institutional order up across different kinds of venues like lit, public dark pool, say exchange dark pool or broker dark pool is largely left, it's delegated to the broker. So it's the broker's kind of, it's the fees that are borne by the broker that is potentially going to create agency conflicts or something like that there.
And if I may add a question, when you try to relate the differences in execution quality to the access restrictions, do you have other dark pool characteristics that you control for in those regressions?
So that's a very good question, and at this point the answer is no. But it's not clear to us what they would be. So for example, one thing that you potentially have in mind is that exchange dark pools are more tightly integrated into the limit order book of the exchange that runs them. For example, I mentioned at the start of the talk that the matching engine for Centrepoint and the ASX limit order book is the same matching engine. So it's much easier to execute a sweep order. So in that setting, like that's something that we've thought about explicitly, and we've made sure that sweeps are not driving our results. We're certainly open to thinking about others, but we don't have many of them that have come to mind just yet. The key thing that we could think of has basically been sweeps and the presence of or access restrictions. But anything that comes up, we would be very keen to start addressing.
Great. So now we have one more chat question from, well, now we have two. The first one is from Peter. How do the dark pools make money? Are there ways different between exchange and dark pool and broker dark pools?
So broker dark pools in Australia, one answer to your question, Peter, is they don't make a lot of money. So they have turned out not to be a highly profitable investment for the brokers themselves. And that's the reason why in our sample, many of them have closed. So, I guess there's indirect benefits of running a dark pool, which is if you believe that running a dark pool, gives you a better ability to service your institutional clients and that you get more institutional order flow generally, then that's helpful. Fees that are attached to the broker dark pools will make their money, but generally the overall share of all broker dark pools is not as big as the share of just Centrepoint. So Centrepoint has been quite effective in providing that service, and their fees are quite high. So the ASX does make money off that.
Okay, so one final question before we move on. Jose Penalva has a question. What are the rules for payment for order flow in Australia?
Jose, the PFOF in Australia is effectively banned. So brokers and other institutions or other potential firms that would do this are not permitted to do it in Australia.
Great.
Okay. Great. Well, thanks for all of these thoughtful and useful questions. So from here, we will give you an overview of our sample. How do we, what are the data sources and so forth, and then spend some time talking about the way in which we define execution quality, or more specifically execution outcomes, and then go into our kind of 3 research designs before talking about our implications and limitations. So our sample for this study are all dark trades, be they on exchange dark pools or public dark pools, exchange dark pools or broker dark pools in stocks that comprise the All Ordinaries Index over about a 2-year 9-month period between 2017 and 2019. The All Ordinaries Index is a market capitalization weighted index of the 500 largest stocks in Australia. So for our market, that's quite a a large representation of the overall market cap of the entire universe of equities. We get these data from Refinitiv, previously Thomson Reuters tick history, where we extract all trades and quotes in these stocks over these periods of time. And then from this, we filter and identify all the dark trades. And we do this in different ways for the different kinds of dark trades. So for exchange dark pool trades, we can identify these directly from the Refinitiv data. They have qualifiers attached to every trade that tell us if it happened on Centrepoint or if it happened on as a CBOE hidden trade. So we see these perfectly. Broker dark pool trades are all reported in our data set with a particular qualifier that is not unique to any one broker, and also contaminated by a very small amount of non-broker dark pool trades. So these trades are all marked with this qualifier called NXXT. So we need to basically take all of these trades and be able to attribute these to broker dark pool trades. So to do this, we obtain, firstly, from CBOE, we actually get their trade reporting data. Every broker dark pool trade that takes place in Australia must be reported on a T+3 basis to one of 2 trade reporting facilities, the ASX or CBOE, previously Chi-X. So between those 2 data sets, we would be able to perfectly match all NXXT trades to a particular broker dark pool. We have it for CBOE. For the ASX, the venue data, the equivalent venue reported data was too expensive. So instead we use a research database that's available to Australian researchers that identify the brokers that report trades. And we match the broker reported trades by volume, qualifier, time, and price to the Refinitiv data. And that allows us to map which broker executed which NXXT trade. And then we deal with the fact that there's a very, very small number of trades that are not broker dark pool trades. And by our estimates from the CBO data, this is less than 0.5% of all the trades that are in fact manual matches that are executed, say, by a sales trader. And our results are insensitive to, we include all trades, but if we filter based on a cutoff that excludes sort of larger trades that are more likely, we get very similar results. I mentioned before that intermarket sweeps are potentially important here, and intermarket sweeps are important because it's much easier to sweep within the exchange on the exchange dark pools and broker dark pools. And effectively what we do is we remove intermarket sweeps, and that weakens every result that we have. So if we were to not do this, we're going to get stronger results. We have about 185 million dark trades across more than 600 stocks and around 700 trading units. There's quite a lot of data there. Okay, so to give you a feel for kind of the data, this figure plots the market shares of the 3 categories of dark pools: broker dark pools, center point trades, and CBO hidden. And you can see the kind of dominance of center point. This is one venue that has between sort of 6 and 9% of overall volume. This is excluding blocks at this point. So this is, you know, about 2/3 of the overall dark pool trading landscape occurs in center point. The broker dark pools, there are around about a dozen during our sample period, and collectively they account for between 2 and 4.5%. And CBO hidden has around about 1 to 2.5% of overall volume. The types of trades that transact on these different platforms are broadly very similar. On the left panel, we have average trade size as a time series across all stock weeks in our sample here. Stock months in our sample here. And we can see that they're pretty similar. The average is between, you know, $2,000 and $4,000 in the start of the period. And there is kind of a downward trend here, and we don't really have a strong explanation for why there's a downward trend. But what would be more worrying for us if there was a downward trend in one category and not another, and we don't have evidence of that. And then the right panel kind of splits us out, gives us a bit more information beyond just averages. And we can see that there's a little bit more mass for CBO trades that are $5,000 or above, but generally these are all quite small trades. So these are, you know, small trades being executed. They're very likely to be, in many instances, child orders of a larger institutional parent order. And it's the institutions that are the dominant players in these broker dark pools. There's no retail flow or very, very little retail flow. Okay, so the first challenge we kind of had in this research project was that it was very difficult to initially think about how one measures execution outcomes in midpoint matched dark pools. And this is largely because these trades are occurring at midpoint, at least, you know, the overwhelming majority of these trades are occurring at midpoint. So the standard market microstructure measures that we have, like price impact, effective spreads, and realized spreads and so forth, they don't work very well. So instead, we've defined sort of 4 new variables that we are using to kind of proxy for various aspects of execution outcomes. And I'll just walk you through these very briefly. So in this paper, we're indexing stocks by the letter J and days by T. So for every trade I taking place in stock J on day T, and the time of the trade is indexed by S, we calculate our first variable as information leakage as basically the absolute price impact from the bid ask, or from the midpoint that prevailed before the trade to some interval tau after the trade takes place. So we're taking the absolute difference between the log mid price tau seconds after the trade versus the mid price that prevailed before the trade. So you would be looking at this, and I expect would be saying, well, there are a lot of things that are potentially driving this. So overall trading activity, the state of the limit order book, volatility, and so forth are all going to be contributing to information leakage. And effectively, it is something of a volatility measure in its sort of basic form. So everything we're doing in this paper, when we analyze these variables, it's really got to be an all else equals kind of argument. So we're saying, for example, conditional on order characteristics, conditional on the stock fixed effects, conditional on date fixed effects, conditional on the on what's been going on in that stock and day. If we see systematic differences in absolute price impact between trades in one category versus another, then we're arguing that that's information being leaked from the dark market back onto the limit order book where the mid price is being formed. So bigger values of this means bigger values of information leakage. Then for adverse selection risk, we're using something a little bit more standard, which is just the bid-ask spread. Price reversals is a dummy variable that takes the value 1 if the return over the first 60 seconds has the opposite sign from the return over the subsequent 60 seconds to 30-minute period. So are there positive returns followed by negative returns? And our last variable is speed of price adjustment. And speed of price adjustment is effectively the difference, the absolute difference between the mid price 30 minutes after the trade and the mid price 1 minute after the trade, scaled by the initial midpoint. And our thinking here is the midpoint 30 minutes after the trade is effectively incorporating all possible information of a trade. So how close is the midpoint 60 seconds after the trade relative to that price? And we're going to look across horizons of 500 milliseconds up to 30 minutes when we look at information leakage and adverse selection. So maybe I'll just stop very, very briefly here and take more questions if they've arisen. Conscious of making sure I've got sufficient time.
Yeah. So Hans Heidle has a question for your information leakage measure, saying that using the absolute value does not take into account the trade direction, which you don't know, I'm afraid, he says. And I'd like to tag on a question to that statement. That you say you can't get the direction of trade because it's midpoint trades. But the Lee and Reddy algorithm that we usually use to sign trades says that if it is a midpoint trade, then as a second attempt, you use a tick test, so relating the trade price to the previous trade price or the previous price change. Does that not work well for dark pools, or why don't you do that?
So we could do that. So we could use a tick rule, and that would classify a fraction of our trades. Certainly not all of them. We'd be losing a lot of the sample if we did that, because they'd have no trade direction because the midpoint hadn't changed from the previous trade. We spent a lot of time, Carole and I, talking in a lot of detail about what does trade direction in a midpoint match means. And another idea that we had tossed around was to look at which order was resting first. And even then, it wasn't clear to us that would be kind of a good gauge of who was the liquidity demander and who was the liquidity supplier. I mean, for these trades, whoever was resting first is arguably the person who has waited the longest. So you might say that should be the trade initiator, but equally they were willing to wait, and it could be that the trade that they matched was in fact a sweep order. So we kind of got to a point, and perhaps this is kind of open to debate, where we thought that the concept of trade direction in a midpoint match just wasn't well defined. So it didn't make a lot of sense to us to say a trade that was a midpoint match was reliably initiated by either party. If both have just entered midpoint orders, then they're equally patient. They just submitted their orders at slightly different times. Otherwise, we could use a tick test and we could try to do that, but still, I guess probably the thing that we'd be most worried about is throwing out a lot of data if we did that. But it could be something that we would try.
Thank you.
Okay. All right. So
other hands at the moment, so I think you can go ahead.
Okay. Thank you. So let me sort of dive into the analysis. So the first piece of analysis, I think, is going to be hopefully relatively relatively familiar to us. We're going to just do a simple kind of panel analysis. So we're going to take all dark pool trades, be they broker dark pool or exchange dark pool, and we're going to estimate the effect of trade location, whether it's on a broker dark pool or an exchange operated dark pool, on execution outcomes. So the data generating process we have in mind is the execution outcome of trade I and stock J on date T, conditional on fixed effects, and this dummy variable is the key right-hand side variable of interest, which is a dummy for the trade being a broker dark pool trade versus 0 for an exchange dark pool trade. We have a set of controls like trade size, price, the spread, the depth, number of trades, total value traded in that stock, and so forth. And we want to estimate this parameter beta. Now, the sample is very large. It got computationally difficult to do this. So instead, we just take stock day averages of the left and the right-hand side of this, and we end up regressing the stock day average of the outcome variable, say information leakage, onto stock and day fixed effects, and this average of the BDP dummy, which is basically the proportion of trades that take place on a broker dark pool. And under the data generating process that we have at the top, if we take the average of this, then that second regression of the stock day averages identifies beta. So to give you a feel for the data, here are our kind of stock day summary statistics. Probably the most important things to look at, I'll highlight for you here in red. So about 27% of the trading takes place in broker dark pools, and a little bit more than 2/3 is taking place in exchange dark pool trades. The absolute price impact at 1 minute is 6 basis points. It's scaling with the square root of time. So as we go to 30 minutes, it's 33 basis points. The bid-ask spread is about 50 basis points before a trade. Around about 12% of trades have exhibit reversals, and the midpoint 60 seconds after the trade is around 30 basis points away from the midpoint 30 minutes after the trade. So here are our panel results for just some of the horizons, and I'll show you the other horizons shortly. We have 60 seconds, we have negative coefficients on absolute price impact. So we've got around a 1.2 basis point difference between the absolute price impact of a trade in a broker dark pool versus an exchange dark pool, conditional on stock fixed effects and controls. At 30 minutes, there's no difference. 60 seconds spread we find is negative and significant, and at 30 minutes it's positive and significant at the only at the 10% level. There's some evidence of reversals and little evidence of adjustments. So this here is kind of one of the key elements of our, or kind of key results. We can see here, this is the coefficient for information leakage at the different horizons from 500 milliseconds up to 300 seconds. And we can see that it's monotonically decreasing, becoming more negative up to 60 seconds and then reverting, and a similar pattern for bid-ask spread. So we're seeing this significant reduction in information leakage out to 60 seconds before it reverts. Now, in the interest of time, the key things that I want to talk about is I want to give you a feel for our matching approach, but I do want to get to our restricted access. So I'll try and give you kind of the key overview of our causal identification strategy here. And then I'm going to move to our the evidence we have around restricted access. So the kind of identification challenge that we haven't met with our panel is that there could be strategic order routing decisions that are taking place at the order level. So we're controlling for stock and day fixed effects, but we're not controlling for, say, a strategic decision by a broker to route really difficult orders to exchange dark pools. So we need some source of exogenous variation in the decision to route. And the way that we do this is we look at the 3 dark pools that closed during our sample period. They're by BAML, UBS, and Citigroup. So when the pool closes, brokers can no longer execute in a broker dark pool. If they want to execute in a dark pool, they have to do so on an exchange dark pool. So we're going to try and use this as a source of variation in the order routing decisions. I'll just show you here for these 3 pool closures, activity in these pools remains pretty steady right up until the closure date. So these are not pools where there's just no broker dark pool flow because the pool has withered away to nothing. They're actively used right up until the point when they're closed. And that reflects that brokers are kind of the key decision makers in where orders get routed. So what we'll do is for each of these closure events, we're going to look at the center point trades that these brokers make. We're going to match the center point trade that the broker makes to a broker dark pool trade in a pool that still operates. We're going to do this by propensity score matching. There's a lot of detail in the paper about how we do this. And in the interest of time, I won't go into this right now, but effectively we're propensity score matching with a caliper. And the idea here, the kind of fundamental identifying assumption is that the brokers whose pools close route a representative sample of trades that would have taken place on their broker dark pool to the public dark pools, to the exchange dark pools. And that by matching, we're able to isolate which these trades would have been, and therefore we're doing a more like-for-like comparison than we would have been doing otherwise. And when we do this, we get very similar results. So across the 3 different events, we find a negative effect on absolute price impact. Broker dark pool trades have less price impact than center point trades by brokers whose pool has recently closed, and that's consistent across all three events. The size of the effect is a little bit smaller than for our panel analysis. That might reflect the endogeneity. It might also reflect the fact that when we do our matching analysis, this is a trade by trade level ATT. Our panel analysis effectively equally weights every stock. So it could be something to do with equal weighting versus number of trade weighting results. We also find smaller bid-ask spreads and relatively mixed evidence around reversals and price adjustment. So our identification strategy here is doing, well, based on the identifying assumptions that we use, and our matching approach is corroborating the evidence that we have from panels. We have a couple of extra robustness things around this, which in the interest of time, I won't talk about. What I'd like to get to is the role of restrictions. So to what extent we've documented here that exchange operated dark pools have more information leakage and bigger adverse selection risk, bigger bid-ask spreads, conditional on order characteristics and using our matching approach. So the question is, to what extent can restricted access explain these? And what's the mechanism here? Well, the mechanism is effectively one of backrunning. Exchange dark pools, they have a lot of trading activity from HFTs, around 15% on Centrepoint in 2015, around 30% on Chi-X at the same period, relative to about 1% on broker dark pools. HFTs can ping pools and execute small orders and trade in the same direction as the opposite side of the trade, which is effectively a backrunning strategy. How do we test this? We're going to firstly, and probably most importantly, look just within broker dark pools at those that completely restrict HFTs versus those that allow some HFTs, but allow their other clients to opt out of interacting. And if the HFT channel is important, we should see exactly the same or qualitatively similar differences in the broker dark pools across the two categories as we do between broker and exchange operated dark pools. We're also going to split our broker versus exchange dark pools by trade size and show that the trade sizes in smaller trade sizes have bigger differences, and I'll explain the relevance of that. So of the roughly one dozen pools that we have in our sample, it's exactly 13 in our sample, 4 of them completely restrict HFTs and another 9 allow some HFTs with opt-into restrictions. And this is the brokers kind of reflecting a trade-off between what's more important. Is it execution risk, or is it the execution outcomes, or potentially that's what this outcome is. So when we look and we do the panel regressions that are analogous to our main panel regressions, but the dependent variable is simply, is this in a restricted versus an unrestricted broker dark pool? And we're only looking at broker dark pool trades, we get the same results as we do, or qualitatively similar results as we do for our main panel. So pools that do not permit any HFT have lower price impact and post-trade spreads than those that permit some HFT. Similarly, when we split our main panel results by trade size, and we're splitting for every stock week, we calculate the lowest decile of trade sizes, and we're effectively estimating the effect of broker dark pool versus exchange dark pool for small versus large trades. We get a bigger reduction in absolute price impact for small trades than we do for large trades. And it's exactly these small trades where the likelihood of interacting with HFT is higher. And this might give you, from a strategic point of view, from an execution outcomes point of view, you might say, well, this is exactly why one should use minimum acceptable quantities on an order. And indeed, that would potentially help, but equally, that's going to potentially reduce your fill rate. And that very much is kind of the key tension that these pools face when they're making this decision about what to do. Okay, so I'm a little bit over time, but I think we've taken a few questions as we've gone, so hopefully that's okay. The key conclusions of our paper are that broker dark pools have less information leakage and less adverse selection risk than do exchange operated dark pools. And broker dark pools achieving this difference, or this difference is being observed because of the ability to segment order flow that brokers have in their dark pools and exchange dark pools do not have. And this explains the differences in execution outcomes that we see. And this is important from a market structure point of view when we think about the regulation that exists globally. The Australian setting is effectively a nice experiment where we can see, based on our unique market structure, we can provide kind of new insights about the roles that segmentation of order flow plays in dark pool execution quality. Now, like I've said at many points, we can't see the whole picture of execution quality. We're providing evidence about one dimension of it, which is conditional on getting a fill. What happens to the outcomes in the rest of the market in the subsequent period? So this is an important element of execution quality, but it's not the whole story, and fill rates matter a lot. And this is also, just to make it very clear, we're not in this paper making any claims about dark trading and aggregate market quality. There's an extensive literature looking into how does dark trading affect market quality, and that's not really the ground that we're trying to walk on here. So thank you very much for all of your attention, and very happy to take all and each of the questions that might have accumulated in the last few minutes. So thank you all a great deal.
Thanks a lot, James. Very interesting. Thanks, Carole, as well. Now we can raise hand either physically or in Zoom. I'll give the word first to Hans Heidle and his question about the absolute value on information leakage.
Yeah, thanks, Bernd. I think my microphone works. Good. Hey,
yeah,
very interesting paper. Enjoyed it. Thank you.
Thank you.
I did want to talk about the absolute value one more time. Sorry to be a stickler on that, but
no,
I understand
not at all. Yeah,
signing trades is a problem for midpoints, but by using the absolute value, you introduce a quite big bias in your measure. I mean, let's just assume there is no information leakage whatsoever, and we just have martingale random walk prices. So you would expect to see a positive or negative price change after the trade, 50-50. Measure would give a positive information leakage even if there's none. So I'm a little concerned about that. I don't have a good answer how to do it. It certainly introduces noise. I also should say I have lived this world, transaction cost analysis, before I came to the SEC. I know quite a bit about dark pools in the US.
Yeah.
And a lot of the things you talk about is one issue you have to deal with. Execution risk is huge. Yeah, there's certainly bias in terms of what gets executed and not. There's opportunistic trading. But that also, I can tell you, there will be many traders who are really good. They basically have negative transaction costs all the time, but by using the absolute value, you get rid of that. So just something to think about. I mean, if I don't think absolute values in that context at all.
So I guess I hear your point. So it's absolutely true that even if there is no information leakage, this variable will be positive. But what we really care about, and I'm not to say that this rebuts your point, it's just when what you're saying and what my kind of response is mentally, it's not that if it's upwardly biased, that's not really a problem because it's not necessarily going to bias the coefficient beta. What would matter for us is if the bias was bigger for exchange dark pool trades versus broker dark pool trades. So potentially that positive bias in information leakage.
I get that. I get that, but that's exactly the point, right? You try to say there's different execution qualities for the different dark pools, but the clientele is different too. It is different. So in that sense, it's not that innocent as it sounds. It's not just noise. It could be indigenous. I mean, there's no doubt about it. I mean,
yeah. No, I agree with that. I guess I don't have. And we can think about this a little bit harder. I can't think of other than the fact that these things are not directly exactly the same, and this is not a perfect natural experiment. I can't quite see which way I would expect that bias to run. And without that, it's kind of hard to address it. But I take your point. It's noisy and it's imperfect, and there is the potential that even our matching approach doesn't deal with it, because really our matching approach is to say there are differences in clientele that we maybe aren't observing, or more appropriately, the brokers are making decisions based on their clientele that are difficult. So I appreciate the point. It's well taken. We need to think about it.
All right. Thank you.
Thank you. Oh yeah, I need to unshare my slides, sorry.
We have a few questions in the chat from Sheng, Cindy, and Edward. So if you don't mind raising your hand, and I'll let you in voice. And in the meantime, I'll take Albert's question.
Yeah, this is super interesting. I'm still getting my head around, trying to get my head around what it means. But the core message of your paper is less information leakage and less adverse selection risk. But I'm trying to see how you can infer that from the measures that you take to the data. And this comes back to the earlier discussion, like how can we sign a dark pool trade, and if we can't, how on earth can we distill an information leakage from it? You see, if it was a buy order and eventually price go up, then you can see how long does it take for the price to go up, and how far does the price go up. So that all makes sense to me, but it seems critical that you need to know what the sign is of the order. And then I understood your philosophical discussion that you and Carole had on, okay, but hey, somebody came early, put in an order, and then eventually somebody else came in. Suppose the first one was a buy order, and then eventually somebody sent a sell order that matched at the mid-quote. But now who's what's the initiations side here? If I have to pick, and I understand the difficulty, if I have to pick, it would be the latter who would be the initiator. Because in a way, if you leave an order out there for people to trade, even if it's at midpoint, there is value to you being there, waiting for an offer, because it's, think about it as options.
Yeah. No, I see what you're saying.
You're providing value. So I'm really trying to get my head around how you interpret what you're finding. But maybe I need to read the paper more carefully. You see where my struggle is? Yeah,
I do, absolutely. So it's well, I think the trade direction discussion is one way to go about this. I think in a world with perfect data, we'd probably be less interested in that and more interested in saying, was the HFT, the HFT in our story is effectively phishing, right? So they are taking one side of a trade, and then we should see them turn around and trade the other side if our story is right. So I think in a world with perfect data, we'd be less concerned with that. So maybe there's an angle that we can pursue that will allow us to more directly corroborate the story by looking at, who's trading. Now, I can't say off the top of my head whether we could do that, but I think that might be also, related to your point, Albert. I take that if you're providing liquidity in the sense that you've got a resting order, then you've effectively sold an option, and that's what we think of as liquidity provision. And the option has a maturity of the speed of cancellation. I don't know whether we can even identify who came first or second anyway, but I think if we could do that, then we could go along that route, and that might be useful too. So
and I'll stop. Another thought that crossed my mind when you were talking about this, you haven't, maybe I missed something, you haven't talked about the latency. When the center point is very different, not only because it's got the dimension you emphasized, that everybody who's at the exchange can trade through center point, and therefore there's undifferentiated access. I understand it's an important dimension, but perhaps an equally important dimension is the latency, that if you must have periods like in any other market where everybody wants to trade, and then the availability of center point and the other dark pool and CBOE is very attractive, because I can get there right away, and I don't have a couple of microseconds latency. And so I'd encourage you to think more about that. It doesn't seem like completely inferior and to be neglected in my mind.
Yeah, no, that's a good point. So earlier when Bjorn asked the question about other dimensions of dark pool heterogeneity, and I mentioned sweeps, and I didn't talk about latency. So I think you've raised a good point there that we should think about carefully as well. So thank you for that.
Okay, so we're on the top of the hour here. We will continue with more questions. For those of you who have to leave, let me just quickly advertise the seminar in 2 weeks. Then we have Mina Lee, who has a paper with Pete Kyle and Eric Budish and more co-authors about flow trading that should be really interesting too. And so thanks for tuning in today. And now we can continue with Cheng Cheng's question.
Hi, James. Maybe I should have asked this question earlier. So for the broker dark pool, when the trader can choose either trade with or not with high frequency trader, do the high frequency traders have the same option as well? Can they take advantage of this option?
I don't know the answer to that off the top. So I can't see why they couldn't select that option, because it, from our reading of the broker pool documentation, it's effectively a menu choice. Carole, I mean, feel free to jump in if you've got more color on this than I do. But I can't see why they couldn't. But also, it's in our view relatively unlikely that they're going to be trading against each other regularly. Generally we would expect them to be trading on kind of similar information in similar directions. But yeah, that's probably the best I could do on that now, Carole.
Yeah, so the ability to opt in and out of flow is at the customer level, and it applies to all customers equally. That you're not allowed to discriminate as the customer makes the choice either at an order specific level or a blanket rule. I just don't want to interact with this flow at all.
Okay, so Cindy, I see you turned your camera on. Do you want to ask your question in voice?
Yes, I can. Hi. A very interesting paper, James, but I do have a question on the differences in fees between the broker dark pools that restrict the HFT access and those that allow the opt-in option. I would expect fees to be higher on the ones that allow the opt-in option, but do you see if there's a difference in that? And a follow-up to that question is are there other types of heterogeneity between the two broker dark pools that should be controlled for?
So on the question of fees, I might again throw to Carole, who I think has more knowledge about the institutional environment than I do here. So Carole, would you be happy to?
Yeah, so it might be useful just to give you a little bit more color on the fee structure. So Centrepoint is the most expensive venue to trade on. And then the lit venues are a little cheaper, and CBOE's fees for hidden are not as expensive as the Centrepoint dark venue. The broker trades you pay a trade reporting fee. So it's not a fee the same way as you pay a percentage fee on trades on other venues. So it's just a trade report fee, and that gets capped at a monthly level. So it's also important to know that typically brokers don't pass those fees back to the customers, right? So from the customer perspective, they are simply charging a basis point fee to the customer given the amount they trade. So it's the cost is being incurred by the broker, not by the customer. So from the customer perspective, there's no difference between the fees across the different broker dark pools. It's just dependent on their broker trading commissions. Does that answer your question, Cindy?
Yes, thank you.
No worries.
Okay, we have another question in the chat from Carole, from another Carole, I assume. So when the three broker dark pools close, do you observe a substitution effect with the CBOE or Centrepoint dark pool?
So we looked into this and tried to detect whether or not we could see these brokers routing substantially more orders onto those venues. But the number of trades that were getting executed in the broker dark pools, even for these, particularly for the major broker dealers like UBS and they're all quite large broker dealers for us in Australia, these three. The amount of broker dark pool trades that were being executed were kind of getting swamped relative to the amount of Centrepoint. So we weren't able to see a clear upward spike when we looked at that visually. So I guess the answer to that is at the surface level, no, but we had extensive conversations with the operators of these pools, and actually in some settings, well, not necessarily with these pools, we keep that information kind of confidential, but we spoke to a lot of broker dark pool operators, and they basically told us that in their view, what the likely outcomes are when a pool closes is that there's just the flow that would have been taken to their broker pool gets split, whether it's pro rata or otherwise, but a good chunk of it ends up going to the public pools. So though we couldn't really detect that statistically, that seems to be the dominant view of what was happening from the industry perspective.
Thanks. So are there any remaining questions at this stage? I have one more, James. I'm not sure you talked about how large these broker dark pools are relative to each other. If there is one dominant there among the 13, I was wondering if a reasonable, when it's relatively few of them in the cross section, a robustness check could be to drop one at a time from the sample and see if the results still hold.
Mm-hmm. Yeah, that's a good idea. Yeah, so effectively recreate the main panel, but selectively removing particular pools to make sure that that's a useful thing. And in fact, we've sort of done a parallel to that with the exchange dark pools, where we've checked that things hold with just center point and no SIBO. So it would make sense to do that on the other side as well. Thank you. That's a useful suggestion.
Great. Thank you everyone for coming here today, and thanks especially to James and Carole for staying up late to tell us about this interesting paper.
Thanks a lot for all your attention and great questions. It's much appreciated.
Thank you. Bye.